In this lesson, we're discussing gaps. We're going to discuss how to identify gaps, where they come from in the market, why they're important. There's a difference between a gap window and a gap fill area. We'll discuss that, why they're important, and of course, how we use them to our advantage. So let's get right into the charts and begin discussing how we play the gaps. We're going to start on a 60-minute chart because we have to be able to clearly understand and be able to visualize where gaps are on the charts. Gaps are simply created when the stock market opens, in this case the ES, opens higher or lower from the prior trading day's close. It's that simple. We don't need to make any more of it than that. The reason why gaps are important is because markets, whether we're talking about the ES or we're talking about an individual equity, it doesn't matter. Markets or stocks will always come back to fill open gaps. And when I say always, it's a little bit tongue-in-cheek. I'm sure there are gaps that still remain unfilled from years ago, for example. However, in most cases, gaps at some point in time will be filled. Since we're discussing intraday trading, we can certainly use gaps to our advantage much more than just looking at daily gaps left on charts from years ago. We're not worried about those. We're worried about a gap that might have been left open from yesterday, for example. That'll be our focus, but of course, any open gap is going to be fair game based on what we're going to learn in this lesson. So let's pick it apart a little bit and decipher what this is all about. So let's take a look right here. This is the 4:15 close. The futures close at 4:15 Eastern Standard Time each and every day. So this is the close from one day. This is the open from the next day. So what we'll do is we'll draw a line based on the closing price of one day and the low of the next day, and then we'll drill down to a shorter time frame so that we can see exactly what happened as the ES came into these gap levels. So the first thing we'll do is we'll put a line on the closing price of this day here. The next thing we'll do is we'll put a line on the low where this gap exists, which is also known as a gap window. So this number right here, this low is 23.78 and a quarter. We'll put a line there. So now we have an example where we have a gap window, which is the top level, and we have a gap fill level, which is the bottom level. This would be the closing price from one day to the opening price of the next day. Let's go down to a shorter time frame so that we can see exactly what happened. Now this will be a good lesson because we're going to get a chance to see a couple of things that we've discussed in previous lessons and how they work, and also why we avoid certain things. So we have our two levels on the chart. We have our 23.78 and a quarter. This will be known as our gap window. And then we have a gap fill that's down here at 23.59.75. What happens is the ES opened up from the prior day's close, gapping higher. We traded higher, and then we started to come back towards the gap, meaning the opening price of the day. And what you can see that happened is we came up short and we began to consolidate over that level. And what we've learned in previous lessons are if we consolidate over a certain level, it's likely that the ES in this case wants to go lower. If it comes straight into a level, that becomes a tradable opportunity. So for example, if the ES came straight into this level and these candles came down and down and down and we came straight into the level without going sideways for a while, we went sideways for an hour here and we continued to go sideways. In fact, we went sideways for a good part of the day. And what that does is it eliminates the opportunity for a trade because the longer an equity, or the ES in this case, goes sideways above a level, the more likely it is to be building energy to go through that level. When it comes straight into the level, it creates a tradable opportunity. Now, even at that, when the ES finally did hit that number, it did bounce a little bit and gave the trade, if anybody were to have taken a trade at that level, it gave about 3 points. That's normally not the kind of bounce we're looking for off of a gap window like this, but as a result of the ES consolidating over this level, it becomes a no trade. We don't want the trade at this point. When it came in to fill the gap right here, we don't want it any longer, strictly because of the consolidation that happened in throughout here. So that's one side of it, and that's also an example of when not to take a trade. But let's look at the other side of the gap and see what happened when price did finally come back to fill this gap. So we're going to fast forward and we're going to go down in time or out in time, and we'll find out what happened as soon as the ES came back to fill that gap. Now here's our level. Now here you can see once the stock hit that price level, as it tested it for about 30 minutes, you can see what happened. We found support at that level and began to trade higher. And this particular trade would have given traders about 5 or 6 points of gain before the ES began to come back in and trade lower. Of course, sometimes you're going to get 3 points. Sometimes you're going to get 6 points. Sometimes you're going to get tons of points out of the ES reaching a gap fill level and bouncing higher, or the opposite direction. Sometimes they will come back to fill gaps from the underside and it will become a short trade, meaning we're looking to sell short the market at the gap fill if the gap fill is higher than we are trading currently. Now right here we can also see another gap level on this chart. Here's an open gap, and what you can see that happened, in fact, let me draw the line. Here's another gap that was created. Here is the closing candle from one day. Here's the opening candle to the next day, and you can see what happened as the ES came back in to fill this gap. It immediately bounced, in fact, on the number this time, and you can see what happened. As soon as it filled the gap, you got a nice bounce higher, and at 23.63 and a quarter, you got a bounce up to 23.6875, and this is all in about 30 minutes worth of trading. This is right off of a gap level. And you can see what happened. The ES came straight into the gap level, which produced a nice solid bounce. You didn't see much consolidation. You didn't see the ES hanging around this level for a period of time. It came straight in, bounced higher, put in a tail candle, also what we have known as a doji candle or pseudo doji, in fact 2 of them, and then we traded higher, and that produced a positive result. Let's take a look at another example, but from the other direction. Let's take a look at an example where an open gap created a shortable opportunity or a short trade opportunity. So here's another example. We'll use this gap left open, which was the price that we're using is 21.50. That's the opening price of that candle. And as you can see, the following day, the ES or the market opened lower, creating this open gap. So if we go forward in time, let's see what happened when we reached back to that price level. So we're going to scroll forward and we'll get to the point in which the ES came back up, and there we go. You see what happened as soon as we hit that gap. I'm trying to get this to stop scrolling. There we go. Let me back it up. My apologies. Now we're still on the 60-minute chart, but you can see what happened here. As soon as we came up into that 21.50 price level, the ES immediately backed off, and it doesn't look as dramatic on the 60-minute, but the price, the next candle, the next hourly price, the low was 21.39 and a quarter. That's quite the pullback from reaching that gap level on a short trade. Let's go down to the 10-minute chart and take a look at exactly what the intraday trade would have looked like. Here on the 10-minute chart, you can see what happened. As the ES came straight up into that level, it pierced through by just a little bit and immediately backed off. And what you can see is from $2,150 in the next, let's say, 30 minutes of trading, we were at a low of 21.3775. That's a 13-point, give or take, trade in just 30 minutes from a gap fill level on the short side. Just like everything else, nothing works 100% of the time, But certainly, as a general rule, we want to understand where our gaps exist on the charts, and when price comes to fill those gaps, we want to be aware of how the market is trading and whether or not there's a tradable opportunity, considering whether or not the market was or was not consolidating above or below a level. If it comes straight into a level, your odds are pretty good that you're going to get a price reaction in the other direction off of that gap level. So as a result, part of our preparation each and every day is understanding which gaps may exist nearby to where price is currently trading, because they will provide tradable opportunities way more often than not.